I just want to take a moment and welcome everyone to the first Home Buying 101 session today at the Linwood Convention Center here for BECU. My name is Walter Weaver. I am a mortgage advisor at BECU, and normally I work in the Greenwood branch and also in the Ravenna University District branch. I've been a mortgage loan officer of some sort or another for, well, I don't know, since 2002. You can do the math. Surprisingly, I'm not that great at it. I thought today we would just kind of do a general overview of our breakout session. I want to bring your attention to a couple items in front of you. You're going to have a questionnaire that you can fill out, a little survey that lets us know how we did. If you would take a moment at the end of the session and fill that out, we'd be appreciative. And then there's also some money on the table for you there. There's a little coupon there that we will sign that is good for $250 off your closing costs if you get a mortgage from BECU. So be sure and get one of us to sign that at the end of the session. So without further ado, I'll kind of dig into the deck. But before I click some slides, whenever anybody comes to me in one of my offices, I always ask them three things, or at least I tell them we're going to talk about three things today. And the first thing is the down payment, right? It's one of the things you need. An important part of the mortgage is getting a down payment together. And so think about where that is. Do you have money in the bank? Are you saving money? Do you have a generous relative that can gift you some funds? Where is it? Is it going to be in a retirement account, et cetera? How much is there and how liquid is it? That's the first thing. Okay, number two, we're going to talk about your incomes, right? So if you're with me in front and doing a home buyer, getting a pre-approval process, I need to know how much money you make. So I'll think about where you've been the last 2 years. Has it been stable? Are you paid hourly, salary, et cetera? So what is your income? And then the last thing is really your credit. I'll ask people if they have a ballpark idea of what their credit score might be, and then also how much your monthly payments are. So do you have student loans? Maybe you have another house already. How much are your debts? So with those three bits of information, I can triangulate, or any one of us who's a mortgage loan officer here can triangulate and figure out how much house you can qualify for. It's actually pretty easy. So thinking about all those, I'm going to dig right into the deck. So I talked a little bit about some home buyer, or some expenses, like how much money you have for things like the down payment and whatnot. So there are 4 basic categories. I put a little caveat that the down payment and earnest money are really part of the same thing. The earnest money is a little piece of the down payment that you give to the seller in good faith, right? And that kind of shows you that you're interested, that you mean business, you want to buy the house. And that's a check that they get to cash. The rest of the money, the down payment, you're going to bring in at closing. So along with that down payment, there's something called the inspection. Okay, an inspection is an important part of the home buying process. We might be able to help you with an inspector, but it's probably more your real estate agent, right? The person who's helping you find the house, they're going to probably come up with the name of a home inspector that you can use. Now, they're important, right? A home inspection can be important. The bank doesn't require that you do one, right? But most people want to know if they have, a raccoon family living in the basement, or if there's any mold or mildew in the attic, or what it might be. All right, and then lastly, closing costs. So closing costs are really, they're sort of in 2 pieces. So the first part of closing costs, I would say, those are like one-time things that we have to pay other people. At BECU, we pay other people to do work for us on the loan, right? Someone has to appraise the house for us. Someone has to tell us that the title to the home is free and clear. Things like that we don't do, those are part of your closing costs. The other part we call prepaid items, and those are things that you're going to pay in advance, right? You're going to pay your property taxes. You're going to pay your homeowner's insurance. You're going to pay some interest. So those 2 pieces together are your closing costs, and we'll take a little closer look at what they are. All right, so around here in Linwood, right? Linwood, you could probably get not a bad home for $500,000, right? It used to be less. It was once $400,000. It was maybe once $300,000, maybe once $200,000. About $500,000, right? That's going to be our baseline. So I'm just going to click through these here. So I talked about the down payment. In most cases, the minimum amount that you have to put down is going to be 3% of the purchase price. In our example here, I think we've got a little more than that, 3 and some change. We'll call it a $16,000 down payment. Okay? That's 3% of the purchase price. Inspection, we talked about that, right? That's to make sure that you don't have the bird's nest in the attic or whatever it might be, right? Inspection is going to cost you about $400, and give or take, and it's paid outside of closing. It's not really a closing cost. I figure usually that the rest of the closing costs together, we talked about those 2 buckets, the prepaid items and the actual closing costs, those are actually about 2, maybe 3% of the purchase price in most cases. So look at that. So with $26,400, remember this number, you can buy a house right here in Linwood. You probably get into contract tonight if you really wanted to. So let's take a little bit deeper look at some strategies for home ownership. Now, loan officers, we have a lot of resources. We can kind of give you some advice as to like, hey, how to save some money or whatever, but we actually work at BECU. You probably know our member consultants better than you know us. They're the people that you come into and you talk to a little bit every day. They are wonderful at helping you figure out a budget, right? So if you say, okay, that's $26,400 that I need to save up for, how am I going to do that? I have, currently I got $10,000 that I have saved up. Okay, so go to your member consultant at your local branch and they can hook you up with that. Okay, so we kind of just talked a little bit, I guess, about the down payment, right? You got to save for that. You got to have some, that's kind of your hurdle, your threshold that you need to get in. Now let's talk about the income piece. So we got to make sure that your income, your salary, your wage, whatever, that it's going to cover the monthly payment and a little bit more. So the monthly payment can have up to 6 different components to it. So the first 2 are principal and interest. So principal and interest, I would describe that as the loan payment itself. You pay that every month, and that loan balance goes down, right? You pay a little bit more of the principal each time. So each time you make that payment, the amount you owe BECU reduces. Taxes. These are property taxes. These aren't sales tax. This is property tax on the house. So the county that you buy the house in is going to know what that is. So once we figure out the property that you're interested in buying, we can look and figure out how much the taxes will be. Insurance. Okay, that's homeowners insurance. We call it homeowners insurance. We sometimes call it hazard insurance. It's the same thing. We just have to make sure that you've got an insurance policy on the house because we've got a mortgage on it. And so if there's if it burns down or whatever, we have the funds to know that it's going to be rebuilt. PMI. So we talked a little bit about putting 3% down. I don't know, you may have heard people put 20% down, 5% down, 10% down. What's the difference? Most of the time, if you put less than 20% down on a mortgage, you'll have to pay something called PMI, which stands for Private Mortgage Insurance. Okay, it turns out that I told you I'd been in this business a while. One of the biggest indicators that someone's going to default on their mortgage is what? Anybody know? Is if you don't put a lot of skin in the game. So the more that you put down, the less likely you're to default on your house. That makes the bank feel good. So in order to ameliorate that, right, we've come up with this insurance policy that you're going to get. It's through a third party. And how much that insurance costs depends on the percent you put down. So I found that there are the rates that you pay on mortgage insurance are different at 3% versus 5% versus 10% down. And then also your credit score, right? So we mentioned we were going to start talking about credit. The better your credit, the better the factor or the rate that you're going to pay on your mortgage insurance. And then lastly, HOA dues, right? So this is common anytime you have a condominium. Also something called a planned unit development, a PUD, right? It's kind of like a condo, but they're houses, and maybe you have some joint keeping of the grounds or a pool or something like that. So these 6 things are all going to be a piece of your monthly payment. Okay, so a couple different scenarios for us to look at. So scenario 1, that's going to be our low money down scenario. That was putting $16,000 down. And scenario number 2, you've got the full 20% down, right? So you can kind of see, if you just kind of look through at the bottom, your total monthly payment, about $32.84, is that what it says, with a low money down situation, and about $2,500 with a full 20% down. So these are kind of the components of your mortgage, right? If this was a condo, you'd have the HOA dues on top of that. People always ask me, well, what are those closing costs? I said they were like $10,000, right? Can everybody see this okay? Can you read this stuff on here? Kind of okay-ish? Basically, the closing costs are in 2 buckets. So I always point people's attention first to the top. The top, you're going to have the loan details. And the loan details basically will tell you the kind of loan that it is, how much money you're borrowing, and then an interest rate and an APR. Okay, what's the difference? Well, the interest rate, 4.375, that's how much we're charging you for the money that you're borrowing. Okay, that $484,000, that's the rate that we charge you. But you have to pay some closing costs, as you can see, to get this loan. And then also, in this instance, it's our low money down situation, you have the PMI, you got the mortgage insurance. So if you look over at the bottom corner over there, bottom corner, second box, total monthly housing, $3,284. It's got those same figures just right in there. Okay, so that's going to be kind of your bottom line. The closing costs in here, again, the charges on this side are going to be our one-time things we do to get the loan done, right? We got to go to the courthouse in Everett and record the loan once it's done. We've got to hire an escrow company. They're going to print our loan documents. They're going to take our money and your money, and they're going to pay the sellers. They're going to call you up and schedule your loan signing. So that's the third-party stuff. This side, on the other side, we're going to set up what's called an escrow account. So anytime you put less than 20% down on a mortgage, we are going to require that we will pay your taxes and your insurance for you on your behalf. So we're going to collect anywhere from 1 month to 6 months worth of property taxes, right, depending on how close we are to when they're due. And then we're going to get your whole first year of homeowners insurance. So in addition to that whole year of insurance, we're also going to get another 2 months. So you put all that together, those are like things you're going to pay anyway, pay ahead of time. We're going to collect for it at the closing table. So here's your kind of more close figure, like $25,000 and change, and again, you're into this $500,000 house. You can come and talk to me or Nicole or any of these loan officers that are in the room with us, right? We can set you up with one of these with a specific scenario. I guess I could take a question real quick. Anybody have a mic? Oh, you don't need one now? Oh, okay.
I'm looking at this saying title, lender's policy, title $2,263.60, and then I'm paying mortgage insurance on top of that? Why?
Well, okay, so the mortgage insurance is for the mortgage. You're paying that because you're putting just 3% down. The title insurance, so title insurance and escrow fees, these are all fees that are regulated by the state insurance commissioner. So the person selling the house, when you buy the house, the seller, typically they will pick the title company that we will be using. So you probably heard them, Chicago Title, Fidelity Title, etc. And what they do is they make sure that the person selling the house has the legal right to do so. You know, they figure out exactly where it is, and then they insure our investment, right? We're putting $484,000 toward it. So they ensure that there's nothing in the way.
They insure you.
They insure us, right. You will notice that you can also insure yourself, right? You have some skin in the game here. You're putting your 3% down. So you have the ability to also insure your portion there as well for $75.
And that's a one-time fee.
Those are one-time fees, exactly. So these are your one-time fees. Mortgage insurance is going to be ongoing. So I should mention about mortgage insurance, it was sort of a dirty word a while ago. really, it's sort of a helpful thing, and it can go away, right? Most of the time, in most cases, mortgage insurance will go away. So how does it go away? Yes. It's right there. It says mortgage insurance. Second box right there on the right. See it there? $300. So let me just tell you, mortgage insurance will go away because remember you put like 3% down in this scenario, right? And we said if you put 20% down, you didn't have to pay mortgage insurance, right? So once your house starts to appreciate a little bit in value, and then once you've been, a couple of years go by and you pay down your mortgage a bit, right? So once you have 20% equity, then you can call us up and we will figure out how to send an appraiser out to your house and they can remove the mortgage insurance from your loan. Okay. All right, so a little bit about credit reports. So yeah, most people have some idea, what their credit score is or what's going on with their credit report, but a lot of people do not. So one way, obviously, you can come to us at BECU and, we can get you pre-approved. We'll run your credit and I'll see what's on there, right? I can't give you a copy of that credit report, but we can review it and we can go over it and say, yep, you've got, this bad news. There's a collection on here. Here's a phone number. You can call them up and see if they can take care of it. You can go to our member consultants. Remember, they were good at helping you balance your budget and stretch that dollar to save for your down payment. Well, similarly, they're also real good at orienting you toward how to get a free copy of your credit report. And I think, in fact, if you bank at BECU, does anybody get a copy of their credit score? Can you see your credit score when you log in online? Right, yeah. Yeah, so we have that available here too. It's a good idea to know what's on there so that you have some idea what you're up against, right? So we can make improvements on it. So FICO. The FICO score is just a modeling number. I think it stands for, yes, go ahead.
Does it affect your credit report, credit score?
Will it affect? I mean, running your credit can affect your credit score. Yes, there is a way to get a copy of your credit report and not run your credit or not get the score. I don't know how that works exactly, but Yeah, I mean, if I run your credit report, it's going to be a little ding on your credit, right? So for most people, that ding is inconsequential. Credit is always in flux. It goes up, it goes down. So a ding like that, if you're the sort of person that keeps your credit history sort of very neat, very tidy, you make your monthly payments, don't borrow a lot, that 3 to 5% dip or 3 to 5 point dip, probably next month, just by virtue of having made your monthly payments on time, it's probably going to go right back up. We don't know for sure, but more than likely it will. So the FICO scores you hear people talk about what your credit score is, it's your FICO score. We pull credit from all 3 different credit bureaus, Experian, TransUnion, and Equifax, right? So we'll use the middle score, right? So if Equifax has you 700, TransUnion at 740, and Experian at 780, we go with 740, right? So that's the score that we use. They're all sort of roughly the same, but have slightly different proprietary scoring models. Okay. Improve your credit. Yes.
You want to avoid that ding, large or small. You get your free credit reports within 2 weeks and bring them in. Is that satisfactory?
Well, I mean, I couldn't pre-approve you with that, right? In order to pre-approve you or even give you a pre-qualification, I got to run your credit report. You just have to decide you want me to do that, right? So if you've decided that, okay, I think my credit score is now about 750, I'd like to go get pre-approved, I want to make a home purchase within the next 90 days, right? Then that's time to come see Walter or Nicole or whoever else and run your credit and get going.
So even bringing in the current FICO scores or the current free credit report.
We can set up like an estimate. We can estimate for you, right? But we can't pre-approve you until we have your credit report.
And those 3 don't count.
Those do not count, no. We need to pull our own, yes. Yep. So ways to improve your credit. Dispute errors. Yes, there are errors. One of the better things about, the Consumer Financial Protection Bureau is they've mandated the credit bureaus really need to clean up their act. They have to clean up stuff that is incorrect, right? So you want to make sure that everything on your credit report belongs to you. Keep proof of payments made. Okay, yeah, keep proof of payments made. If you have you're fighting with a creditor, you're fighting with Macy's, you say you didn't make this payment. Yes, I did. Here it is. It just kind of goes without saying. If you keep track of what you're spending and what you paid off, that's going to be easier for you to dispute with your creditor. Pay down debts. This one's important, especially revolving debt. Okay, revolving debt, that's a credit card, right? A credit card is a revolving debt. It means that you can charge it up, pay it down. It kind of just keeps going, keeps revolving. You just pay that minimum every time, right? So if you pay those balances down, then you will see your credit start to improve. Now, it may not be instant, right? Because credit report's a snapshot in time. So somebody, just because you paid your balance down today doesn't mean that right now, tomorrow, you're going to have an improvement in your credit score. It might be a couple cycles before you see that benefit. And then make your payments on time. This is especially true if you've had, well, you always want to do this, but if you've had an event in the past, like let's say you did have a bankruptcy, let's say you did have some event, a really, you didn't pay some student loans, they went to collections, but that's all cleared up now. That's fine. Just make sure that everything you do since that date is clear. Then the underwriter, when they're looking at your credit report, can say, okay, yeah, they had this event, this was when they weren't working, or they weren't making as much, or they were less responsible, or whatever it might be, and now this appears to be under control. Okay, so I wanted to show you a slide that kind of underscores how having a good credit score can really benefit you financially. I couldn't really believe it when I was working on this slide with my coworker, the difference in monthly payment, but it was true. So I ran one scenario, excellent credit. At BECU, we're pretty generous, actually. Our best interest rates are available at scores of 740 and above. I don't know if that's too much information to give you guys, but 740 and above, you're eligible for our best credit, best rate information on mortgages. So I ran one at 740. I did another one at, I think it was 620. And, well, a couple things happened. This is the same loan. So this is like a low money down situation, like with $16,000 down, $500,000 purchase price. So you can see the interest rate right off the bat is a little lower, right? 4.375 with excellent credit, 4.5, 4.5 with poor credits. So your principal and interest, of course, is going to be more. But look at this PMI. Look at the mortgage insurance. Okay, $303. We've seen this number before on my earlier slides. And $907. Okay, $907. So $600 a month more, right? Just because your credit score is 80 points below where we consider excellent. So, more than anything else, I find what kind of shoots the idea of buying a home out of the water is when your credit isn't that great and you need to only put a small amount down, right? Because then you're going to have to just pay more on a monthly basis. Yes?
Is there like a in-between, or is it just excellent?
Oh, no, it's definitely a sliding scale. Yeah, definitely. Yep, absolutely. So your closing costs are also going to be more expensive, right? So when you have less than good credit, you have poor credit, right? You may have to pay something called points, right? 1 point, you may hear people talk about this, loan officers talk about this. All that is, 1 point is 1%. 1% of the loan amount. So $500,000 loan, 1 point is $5,000. So if you have maybe not that great a credit, you might have to pay a point, maybe more, to get the same rate that someone with a little bit better credit has. Conditional approval. Okay, so now we're going to talk a little bit about our process at BECU. And I have to say, I've worked at half a dozen mortgage companies in my lifetime, and our process of getting you pre-approved is pretty slick, pretty easy. The first step is you have to decide to come either see one of us in person or call us up, on the phone. I think you can also go online directly and do it there as well. But you have to come in and submit an application. So after you get your application submitted, then we're going to ask you for some documentation. Okay, so this is thinking about you work with your loan officer to determine what this is. So for most people, it's going to be 1 month worth of pay stubs, okay? Your last 2 years of W-2 forms. Okay, then we're going to need to see any non-BECU bank statements, right? You've got a bank account somewhere else, need to see that. Anytime you're going to use any money, from outside BECU, we just need to verify where that is. So we'll verify all that stuff. I will send, if you're sending it to me, you come and see me. I send your stuff to an underwriter, right, working at one of our centers, and then she will approve your loan, ideally. So what I can issue you early on after you submit your application and give me your information, I can give you a pre-qualification letter. Okay, pre-qualification letter. Ours are pretty strongly worded. People make offers with them all the time, right? They look good, they're legit. But here at BECU, we'll go the extra distance and we'll waste not just my time, but also my underwriter's time. We'll tell, hey, these people really want to be approved. So let's go ahead and get them approved, and then she'll review the information, and she's the one who actually stamps it. That approval then is going to be good for 90 days. So you've got 90 days, and that's because most credit reports are good for 90 days. So after that, we may have to run your credit again. Yes? Yep. The pre-qualification process can be like 30 minutes, right? That is really quick, right? Because we're going to run your credit report. We're also going to run a system called the desktop underwriter, and it's going to give me like a decision, and that's what I read. To get you pre-approved, that's a moving target, right? Because there's other people involved. That's probably, I think currently it's about 48 hours or so. So if you've got all your stuff ready in 48 hours, you have a pre-approval. You could, yeah, you could. The challenge you'll have, though, is that most real estate agents want to see that you've been pre-approved before they consider your offer. Well, I mean, yeah, I mean, you'd have to go out on a leap. I mean, usually when you present an offer to a real estate agent, you hand them a pre-approval letter. Yeah, I mean, it's just kind of a cost of doing business. If you really want to get a home, if you're in the market for a home and you're thinking it's going to be, 2 to 6 months, we may have to run your credit a second time. It just happens. Yep. Okay, I'm going to blow through some slides here because I have some I know we're kind of getting short on time here, and I want to make sure I cover some stuff. This is kind of a list of the stuff that you're going to need to bring us, right, or send in to us. And so, basically it's the stuff I mentioned before, pay stubs, W-2s. If you're self-employed, you can then look at your tax returns. We're going to average what you've been doing the last 2 years if you're self-employed. Okay, next. A couple kinds of home loans, guys. There's fixed rates, right? So obviously a fixed rate never changes. They have different terms, 30 years, 15-year, 20-year. We have a 12-year. We'll talk about what's right for you. Versus an ARM, an adjustable rate mortgage, okay? These also have fixed rates, but just for a shorter period of time. So they've got a fixed rate for 5 years, or 7 years, or for 10 years, and then they can become adjustable after that. They do have a lower interest rate, usually, than a fixed rate, which is why people like them. Obviously, with fixed rates, you've got your interest rate will never change. Your payment could increase over time because we all know, especially in Seattle, and environs, the real estate values go up. So we've got to always deal with home prices increasing and our property taxes going up. Adjustable rate mortgages, I mentioned, they've got a lower rate at the start, right? 5, 7, or 10 years. And then usually after that initial period, let's say you get a 5-year ARM, in year 6, it can start to adjust, right? So it'll go up or down depending within certain parameters, usually. And you can talk to one of us online. We can kind of go over what that's like. And when you talk to us online, we can kind of ask these questions for you. So, yeah, maybe you're not going to live in Seattle. Maybe you're here on a temporary assignment. Maybe you're going to be here for only 5 years. So why not consider an adjustable rate mortgage and save yourself a little bit of money? Or maybe this is going to be the house of your dreams. Maybe you want to go with a 30-year fixed. We will help you uncover that. Okay, without getting too much arcane knowledge to you guys, there are all kinds of loans out there. Okay, at BECU, we are a full-service mortgage provider, which means we can do jumbo loans. As the name kind of indicates, they're like a big loan, right? They're over 400. We consider them at 484,000, 484,100, in fact. Anything over 484 can be considered a jumbo loan at BECU. Conforming and high balance loans, these are loans that we're going to be getting sort of some of the funding from Fannie Mae, right? We can sell these to Fannie Mae if they're conforming, and they're going to range in price from $50,000, our minimum loan amount, up to $726,350. Home Ready, this is a program that's popular with lots of first-time home buyers. It lets you put 3% down, and it has a lower rate of mortgage insurance than other kinds of loans, right? So you can talk to us about how to qualify for that. And then VA loans, you have to be a veteran. If you're a veteran, or if you're active duty military or a reservist, you can talk to us about a VA loan. They have a lot of good benefits. Okay, so this is the good stuff here. Okay, so did you know at BECU we're a credit union, right? So one of the things, we have to give some money, some of what we earn from interest and other things, back to the community. And one thing that we have done, this is our second year now, is we've developed a first-time homebuyer grant. So this is available to any of you, right, possibly, as long as you earn under the area median income. So area median income in Seattle, Pierce, Snohomish County is going to be $104,300, $104,300. So if you earn under that amount, you might qualify for this grant. We did this so that people, who are having a hard time saving that $26,000, remember that $500,000 house, you needed $26,000. This can give you a leg up to buy that house. So we'll give you up to $6,500 or 2% of the purchase price, whichever is less. Couple qualifications about the grant. It's only available here in South Carolina and a couple counties in Idaho. Maximum loan amount that can go with it's that $484,100. You have to agree to be in the house for 3 years. You need to be a BECU member, which shouldn't be a problem. Good credit history, right? We have a pretty decent credit criteria for it as well. Can't have owned a house in the last 3 years. You can use it for the down payment and the closing cost. You can't be over that income limit, $104,300. And then you got to attend a home ownership course. Here you are. Oh yeah, and it's got to be your residence. Can't be a second home, vacation home. So think about that. So I just said here's $6,500. So we're talking about $24,600 or whatever it was to buy this house. So now imagine you get $6,500 from BECU. Okay. We have another way that we can give you some money towards your closing costs at BECU. So one way we might do that would be if you called one of our real estate agents. We have partnered with real estate agents in the area, right, around the area geographically. And basically their value proposition is that, one, they're going to be good. We vetted them, BECU, but they will give you a percent of their commission. They're going to give you up to 20% of whatever they make on buying that house for you. So let me just show you what that would be like. So you had $6,500 coming from our grant. Now, if you bought that $500,000 house, you'd be getting $3,000 back from the agent. So that's almost $10,000 off. Think about it, $16,000, and you are buying a house right here in Linwood this weekend. Okay, that's it, guys. That's our presentation for today. I want to thank you guys for coming. I will open the remaining time we have available for questions. I do have, if we get kind of a lot of questions, we have a couple of loan officers around that can answer. Yes?
Why do you get dinged when you get your credit check? What does that
Well, generally it's because we don't know, or the credit reports agencies don't understand what you're doing. You may be opening up a line of credit, right? You might be opening up a $100,000 open-ended line of credit, and we don't know that. So if we see a lot of inquiries, that's kind of one of the reasons. We have to determine what you've done with that credit inquiry.
Why do they care?
Well, it's just a model that they've made, right? I mean, the financial institutions, haven't really come up with a model. It's credit reporting companies that have, but because I guess they want to make sure people make their payments on time. Yes.
I'm sorry, what was the percentage that the real estate agents would give back?
20% of their commission, right, yeah.
And is that like would that be something that the BECU or loan officer would like give that list, or how?
So, not exactly. If you apply with us and you're interested, we click a little button and you'll get a phone call from one of our partners. And it's not actually the real estate agent at that point. It's like the agency, if you will, that vets them and works with us. And they say, hey, are you interested? And then they'll connect you with the agent. Yep.
Are there any homes that don't qualify for the first-time home grant?
I mean, it has to.
Cities that maybe have restrictions?
No, there wouldn't be restrictions geographically. I mean, it's really the purchase or the loan amount. So if your loan amount is over $484,100, then you don't qualify for the grant.
If it were like a townhome, does that matter?
Oh no, it can be a condo, townhome, absolutely, yeah. Mhm. I think I have time for one more question, and then I'm going to go send you to go see Benson or somebody more exciting. Well, I'm sorry, what was the question? Multifamily housing for the, do we finance those? Yes, absolutely, yes. The rules are going to be different on duplexes. You may have to put more money down. I would talk to a loan officer offline about that.
So are they considered commercial loans?
No, any residential, any loan is a residential loan from 1 to 4 units. So over 4 units, if it's 5 units, it's a commercial loan. That's right. Yeah? Okay, thank you guys.